Let's talk about the Toronto housing bubble. Let's talk about this bubble that has to burst because homes in Toronto are just unaffordable. I'm going to share my screen with you. You're going to see the market dynamics at play here, and I'm going to walk you through how this basic economic machine of the housing market really works. So it's no secret that the housing market is driven by two primary factors, being supply and demand. The question is, what are all of the micro factors, you could say, that make up supply and demand and shape where supply and demand is going? That's what we're going to get into a little bit today. So there are a number of factors, everything from transactional costs, developmental costs, construction costs, levies, that change the availability of new homes, as well as the land availability and cost, and of course our government meddling in developers' profits. On the demand side, we have everything from immigration to wage growth and lower rates, which is a function of affordability, and we've got speculative investment in foreign and laundered money. Foreign and laundered money, mostly media boogeyman. They love to claim that's where the housing growth is. The reality is, based on the RCMP's alarmist report, we're still well within normal range. Fund money laundering and foreign buyers are a problem in every financial asset. Toronto's not, we're not unique in that way. But anyways, let's get into the rest of the factors here. Okay, so to understand where we're going, we need to understand where we've been. Now, last year and in 2017, there was a bit of a slowdown, at least in the detached market there was, and you can see that where the detached market had a little bit of a price regression. Well, what a lot of people don't realize is the condo market did not regress. Prices did not slow. In fact, growth continued through that period. And the reason is because of the mortgage stress test and the fair housing plan. So the fair housing plan and the mortgage stress test were, enacted. What we saw was the signs of a housing bubble. What we saw was the bull trap and the return to normal before the crash, except the crash never came because it was never a real crash. What happened was buying power was bitten. So the average person had to qualify for a mortgage. They had to qualify with a lot more income than they did, about 20% more income. And ironically, we saw about a 20% price regression in some of these homes. So that is where the detached market crashed. Now, the reason that the condo market didn't also see price regression with the addition of the stress test is very simple. You've got all these buyers, you've got all this demand, and suddenly they can't afford the detached homes. Where are they going to go? Well, most of them are going to go to condos. So now you've doubled up your buying pool for the condos. You've seen a price growth in condos. And in 2017, we saw as much as 25-30% appreciation in some key pockets of downtown for the condo market. The other reason why we saw the crash in the detached price and not the condo price is because of the price gap that had grown over time. So what happened is, throughout the 2015 and 2016, you might remember detached were all the rage. Everything was getting multiple offers. And that price gap between what it cost to buy a condo versus what it cost to buy a detached home grew and grew and grew to an unhealthy rate of about 2.5x. That is not a normal multiple. You go to any other major metro area and you'll find that 2x is about a healthy multiple. We have since returned to that. And so you can expect detached prices to start, and we've already seen it. Detached prices are starting to pick back up along with condo. In order to explain the next few things, I got to explain months of inventory. Months of inventory or absorption rate is just a way of explaining supply versus demand, okay? It's a way of saying how many buyers are there in the market and how many properties are there to meet those buyers' demand. So, for example, if you have 1,000 listings in the market and you sell 500 listings in 1 month, you have 2 months of inventory, meaning that if nothing else listed, because you're selling 500 units a month, you'll sell the full 1,000 units of inventory in 2 months of time. Okay, anything below 3 months of inventory is considered a seller's market. Anything below 2 months of inventory would be considered an extreme seller's market. Balanced market is somewhere between 3 to 7. Balanced market, you're going to see regular price growth, 3, 4, maybe 5% price growth, depending on where you are. Buyer's market is when you start to see prices regress. So what happened with the Fair Housing Plan and the stress test? You can see it clear as day. Months of inventory spiked. So while multiple offers were happening in price, we were seeing massive price gains in the detached market. Suddenly, that stress test comes into play, announced rather, and the Fair Housing Market comes into play. And the inventory on the detached market just sits. And in that, buyers started to have an opportunity, prices became negotiable, and we saw a little bit of a price slide. At the same time, what we saw in condos is exactly what I said earlier. We saw a lot of the buyers who were, initially qualified and looking at detached homes now suddenly slide into the condo market. So we see that inventory get absorbed a lot quicker. We slide below 2 months of inventory, and suddenly, prices in the condo market are going up double digit year over year. Okay, so on the demand side, we have to talk about speculative investment. Obviously, if somebody's buying a home for themselves, that's one thing, but if they're buying a home to rent out, that's another thing. Is there an exuberance of speculative investment like there was back in the 90s with the 90s crash? The definitive answer is no. Our homeownership rate is still extremely high by North America standard, okay? Montreal has a much lower homeownership rate than us. Why does this matter? Well, this tells us how many people live in the home that they own rather than rent. We still have a very high homeownership rate. And keep in mind, this is based on the 2016 census. So I'm sure in 2020 we're going to see this number go down a little bit, and that's only natural. As a major metro area becomes less and less affordable for the average person, we see a higher and higher renter share. But as of now, currently, we're still very, very healthy and within range. We do not have an exuberance of investment. In terms of wage growth, so we don't have wage growth where we should. The reality is Toronto wage growth has been stagnant for some time, but we're not that bad. We are getting some high income, tech jobs. The tech industry and the tech sector in Toronto is exploding. In 2017, we saw, just under 29,000 jobs created, and that's more than the Bay Area, Seattle, and Washington combined. And, we're seeing a ton of U.S. investment into Toronto specifically for that tech sector growth. Immigration is only going to increase in Toronto. So, last year seemed like an anomaly, and it was, historically speaking, we're immigrating more than we ever have. However, that is only projected to continue. The government wants to keep immigrating to keep, population growth high and to keep economic investment high. So they're going to continue to immigrate people. The other thing is, sometimes people will say, well, immigrants don't have money when they come here, by and large, so they don't buy the home, so it's not an issue of supply and demand. Well, the reality is, a home occupied by a renter or a buyer is still a home occupied, okay? If everyone's coming here renting, then that means it's driving up the rental prices, making it easier to cash flow on rental properties, making more people invest in rental properties. So ultimately, people are purchasing the properties to rent them out anyways. A home occupied is a home occupied. Whether by renter or by owner, it is still a function of demand. One is one. It doesn't matter who's occupying the unit, okay? The other thing is the stats show that newcomers to Canada do buy. It's not just a Canadian culture thing. Everybody wants to own the land that they live in. Everyone wants to own their condo, own their home, whatever it is. They understand it's most likely the best way of, securing their retirement savings and all these things. So it's, 30% is a pretty high number here, but many of them rent. Some of them live with family and friends, but plenty of newcomers buy, just like you and I. Now, I'm going to get crucified for saying this, but I do think it's important to note that in terms of a function of affordability, Toronto is still one of the most affordable and the most desirable major metro areas to live in North America. I think it's 2 years in a row now we've been rated the #1 best quality of life for a major metro in North America. And, the prices are starting to finally reflect that. So we've been a bargain in times past, and that's why many people who have lived in Toronto feel like it's all of a sudden unaffordable. The reality is we're just now coming into our own. We're just now becoming this noteworthy major metro, this world-class city, and the prices are starting to reflect that a little bit, but we still have a lot of room to grow. In terms of affordability, people like to look at median condo versus median income, or median home versus median income, and that's something we can do. Toronto isn't hitting this glass ceiling of affordability, and we're not going through a transition that other cities have not. In fact, Manhattan has went through our transition, 15, 20 years ago. And so we can just look at them to determine what affordability really means. In terms of when you adjust the Manhattan income to the Canadian dollar, they make more than us, okay? So their average household income in New York is $75,900, whereas it's $65,800 here. And when you adjust their condo price, one-bedroom condo price, and keep in mind this is for Manhattan, and the one-bedroom median condo selling price for Toronto is not the GTA, okay, it's downtown Toronto, CO1, it's the downtown core district. It's $600,000 versus $1.25 million, okay, in Manhattan. So when you do the multiple of median income versus median condo price, it's 9x in Toronto, where it's over 16x in Manhattan. So clearly, affordability isn't our ceiling, at least not yet. Now, on the topic of affordability, some people think that it is the government's job to get involved in the housing market to make things more affordable for first-time buyers. Now, I'm sure you know what I think about the government getting involved, but I'm going to say it anyways. It's a bad idea. It always has been, and it never goes well. So when you look back to the Fair Housing Plan that Kathleen Wynne and her team implemented in 2016, they wanted to make the housing market more affordable, both for renters and for first-time buyers. And look at what happened. The rental prices surged dramatically. Of course, during this time, prices did as well, and it was more a function of supply and demand than bad regulation. But this just goes to show that her regulation didn't do anything, okay? On the topic of supply, the number we're looking at is the new home completion. This is public data. You can go get this from Census Canada, from Stats Canada. This is tracked very accurately. So here we have the GTA versus Toronto new home completions. If you'll remember, we saw 77,000 people in Toronto last year, net migration gain, and we saw 125,000 in the GTA. You can see these numbers here. We're averaging about 15,000 units in Toronto per year for 77,000 people, right? And in Toronto, in the GTA as a whole, we're averaging about 35 peaking at about 40,000 units per year for, again, 125,000. The numbers just don't line up, even if you're assuming dual occupancy, 2 people per unit, which we know is a high estimate because the government does keep statistics on this kind of stuff, and the average condo occupancy is 1.5 people. So to satisfy a demand of 15 people, you need about 10 condos. These numbers just don't line up. With these types of numbers, we're going to continue to see price growth in the high single to low double digits. On the topic of new housing supply, something we need to look at is how affordable it is for developers to actually build the supply and bring this product to market that we so desperately need. In saying that, we need to look at construction costs, land costs, and development charges. So development charges are a big part of any construction. Development charges, essentially what they boil down to is their cost that the city is charging the developer in order to support infrastructure in the neighborhood. So, when developers put up a bunch of condo buildings in a neighborhood that previously didn't have them, you need schools, you need parks, you need sidewalks, you need all kinds of things. And so that's what development charges are in theory for. In Toronto, we charge the highest of development charges in North America. I would even bet potentially the world at this point. We're charging, last year in 2018, the average developer has paid $164,527 per unit. So you can do the math. If they did 1,000 units, they're paying that per unit. And ultimately, where do you think those costs get passed on to? They get passed on to the buyer. Whatever pre-construction purchaser is purchasing the unit, these costs are built into the price. You can guarantee it. These developers aren't doing, they're not non-for-profit organizations. One other thing we got to consider here in Toronto, specific to us, specific to the GTA as a whole, is the green belt effect. We are landlocked. There's only so much building area that we have. We still have a good chunk left, but we're running out really quickly. Even this optimistic report says we've only got enough really till 2031. And you can see on this map that almost everything is built up. Almost all of the land is used. There's very few plots of land left, and that's why you're getting developers doing crazy things now, like building on top of heritage buildings and all kinds of stuff like that. We're just running out of land to provide the supply needed to meet the demand. So I'm not sure where prices are going to be in 15 years, but they're certainly going to be higher than they are now. The other day I had a client say to me, I'll invest when the market crashes. And this is, the 10th time I've heard this month. It's not unique. Some people think the market's going to crash. That's just natural. People are pessimistic. But look, you're not going to time the market. The reality is trying to time the market is going to more than likely just result in you missing out on opportunity after opportunity and eventually buying in at a much higher price than you could have. So this graph does a really good job of illustrating. Someone dubbed Bob the Unlucky Investor. So Bob the Unlucky Investor invests $400,000 over a number of years, over 50 years. He invests it at the worst time. So in 1972, in 1987, in 1999, and in 2007, the worst crashes of the U.S. economy, okay? What happened? Well, after investing $400,000 at the worst time, and his investment would have crashed right after, his current investment value with dividends reinvested is still $11,850,000. So in a market like a housing market, in a stable market like the housing market, the U.S. economy, the S&P 500, you are not looking at a year spread, okay? You're looking at 10 years. Our goal is a 10-year spread because nobody loses money in a 10-year spread in real estate. Okay, you can find examples of people losing money in 5-year spreads, like, for example, buying right before the 90s, but you can't find examples of people losing money in 10-year spreads, at least not in major metro markets like Toronto, not in New York. If the immigration continues, if the economic growth continues, there's no reason why you should be waiting to get into the market. You're only going to cost yourself more money. And this is the power of leverage. This is why we invest. So, for example, if you were to have bought a 600 square foot pre-construction in King West back in 2010, you would have paid about $295,000. Okay, you would have closed on that in 2014. You would have put $59,000 down and waited until it was ready in 2014. And it would have been worth at that time about $343,800. At this point, including $9,000, $10,000 in closing costs, you've got about $68,000 worth of capital invested into this property. Then you're going to rent it out 2014 through 2019. Okay, you're going to rent it for $1,750 a month. This is all real numbers, by the way. This is a real unit. Your expenses are about $1,450 a month. So your positive cash flow is $300 a month. You are being paid $300 every month to own this asset. In addition to that, your tenant is paying down your principal by $437 a month. So your net worth is going up by $737 per month. 2019, if you were to sell it, it would sell for about $596,400. Adding up your principal payback, your capital appreciation, and your cumulative cash flow, you've made $345,000 over a 10-year investment with only a $60,000 initial investment. This is why we invest in real estate. This is why you're looking at a 10-year spread rather than what's going to happen tomorrow. And this is why you're not trying to time the market. We look at the macro. How many homes are we building and how many people are we bringing in? And based on those numbers, we know that property prices over a long enough time, if these levels continue, they're only going up. If you have any questions, comments, if you have any questions regarding the market, if you want to get into the market, if you're looking at pre-construction as an option, as an investment vehicle for you, reach out to me, Jordan at precondo.ca, or check out our website, precondo.ca. We've got all of those things on there. Okay, take care.